Hello. In the previous class, we discussed about fundamental analysis. Fundamental analysis for the particular stock to invest. Fundamental analysis is divided into three parts, starting with economic analysis, then we have industry analysis, and followed by company analysis. Company is the micro in nature analysis as per the analysis, whereas the macro analysis in economic analysis, and industry is talking about the which particular industry or sector that particular company belongs to. A thorough analysis will be done in that case. The industry analysis and company analysis will be covered in the subsequent sessions. Last class we discussed economic analysis part 1. Now we are going to continue this particular analysis. Let us have a recapitulation of what you discussed in the previous class. Coming to that, we have discussed about the importance of economic and industry analysis, EIC analysis for as a part of fundamental analysis. Then we talked about the major macroeconomic factors like GDP, growth in industry, employment, monsoon, agriculture, all those things are there, interest rate also, all those things are there which are going to affect a economy subsequent to the industry, and also at the end of the day it also going to affect the particular company's stocks performance. Then we talked about the demand and supply shocks in the economy. Demand shock is something which because of that there is some big demand or lower demand for the particular products and services in the economy. Supply shock is in the supply side, like determines something which is affecting the wage rates of the economy, something which affects the cost of material, something which affects the cost of capital or the factor of production like capital for that matter. Then we talked about government policy like fiscal policy, budgetary policy. We talked about the monetary policy. These are also certain things which affects the economy, whether it is in India or elsewhere for that matter. The different governments have their different policies, fiscal policy and financial policies are there which affects the particular economy and the sectors and the stock at the end. Then we talked about the economic indicators which indicates whether there is a boom in that or there is a recession in the particular sector or particular economy for that matter, how it is moving, when the recovery is going to happen, or the best phase of growth has taken place. We can look at the different indicators and find it out. Now, in the economic indicators, we had certain things like cyclical indicators. In cyclical indicators, that means there will be certain trends in that, and there are leading indicators, there is a coincidence indicators and lagging indicators. We will also talk about diffusion index in this session, and also going to talk about the econometric models which can be used, or where you can talk about certain variables which can affect and we can consider to find the performance economy or stock for that matter. Then coming to the cyclical indicator that you already discussed, these are the indicators which is in that we have leading indicators, those indicators which happens earlier to the economic whatever is happening. That means there is a peak in this particular indicator and then comes the growth in the economy. That means GDP growth will be more, and before that this indication might have shown a growth for that matter, or this indicator might have shown a decline which will be followed by a decline in the economy as such. So, they lead ahead of the economic trend as such. So, there is different leading indicators like that. You have manufacturers orders, vendor performance, money supply, and then stock market performance. We have looking at Indian context, we have these two indicators, like there is a trend in Sensex, there is a trend in also broad money, there is M3 that is there. So, we have taken the data from the RBI's database and we found there is a increasing growth in the long term since 2000. In the last 1 year, we see there is a continuous growth in both in the Sensex as well as the money supply. So, these are certain things. There are a couple of other indicators which can also, and combinedly all these indicators put together, we will talk about whether this overall economy is going to be growing ahead of this after this growth in these particular sectors, particular indicators or not. Coming to the next one, we have got coincidence indicator. Coincidence indicator is something which is which will have the same growth or same fall or whatever, same trend in the indicator like the economic growth as such. So, they will be like parallel to the economic indicator graph for that matter. So, that indicator that you have is personal income, less transfer payments and index of industrial production, manufacturing and trade sales. If you look at one, we have a growth like this. This is a growth in index of industrial production in terms of percentage. This growth we can see it, which is 94, 95, then 95, 96 it was something around little more than 13%, which has declined 96, 97, then like that it has fallen, then it has again recovered, and 2006, 7, 7, 8 we find there is a peak in this one in the recent trend, then it has again fallen. So, this you can see this particular fall in the growth rate is almost same like the fall in the overall market. Also there we can would see that the market growth was, the GDP growth was not that higher in 2008-9, which is expected to recover in 2009-10, which is also reflected in this particular graph that 2009-10 there is going to little more industrial growth in IIP and percentage is going to more, and we are expecting that the overall economy also going to be little better than the last year. Then coming to the next one, we have lagging indicator. These are the indicators which lag behind the economic indicators. So, certain examples you have is unemployment, then inventory sales ratio, then you have prime rate charged by banks, then you have loans outstanding. That means if there is a economy going to be better, subsequently this growth, there will be a growth in these particular indicators afterwards. So, there is going to be a lagging after the growth has taken place, there is a growth in this particular, there is a decline in the overall economy, then the decline happens there. Then we can see an example here, the lagging indicator you have a gross bank credit to industry, which is increasing, but one has to plot this particular thing with reference to the overall economic growth and find out how much is lags compared to the economic growth for that matter. Then having done all those things, these are all the things again what happens in plot in case of business cycle. This is an example taken from the US data as such. One can see here there are different recessionary periods here. These are the green shades, then you have got lagging indicators there, then you have got the leading indicators there overall, then there is a coincidence indicators. So, this is one can take a very long range of data, long period of data and plot these indicators against the recession or whatever that may be against the economic growth and find out how they are moving as such. Then coming to the next thing that you have got, that is we are talking about diffusion index. It is a looking at this index one can find out how widespread is the phenomena as such. That means in particular set of indicators there could be couple of indicators, let us say coincidence indicator or the lagging indicators or leading indicators for that matter. Among the 10 indicators are there, how many of them are actually moving in tandem and they are going up? As a let us say the 10 indicators are there, maybe 8 of them are going up in a increasing, that should be there, while the rest 2 may not be increasing in that way. So, that means that is little prevalent, this that growth is going to happen, is going to more justified, and that particular indicator more useful for that matter. Then we can also look at the direction of change, how it is going to happen, the rate of change for that matter. If these indicators are going up in an upward movement, that means there is a increasingly increasing or decreasingly increasing growth for that matter. That means growth is there, but the maybe 10% was then it has been 8%. So, how it is going up, or 10% was then let us say it become 12%, this is 14, this is increasing growth rate for that matter. So, looking at that, the broad trends can be found out, how this all the overall indicators are moving, what is the growth there, and all these things can be where we talk about diffusion index. Then we moved on to the econometric models here. Here you talk about the, that means when you talk econometric model, we talk about that yes, the function of the or the output from the economy, let is GDP or whatever that may be, is dependent upon certain factors like money supply, taxation, prices, wage rates or wages for that matter, interest rates. These are 5 broad things. There could be a couple of other things can also be there which affect the performance of the economy, and so what can happen, one can have a relationship like economic indicator in terms of let us say GDP is a function of all those things like money supply, taxation, prices of the commodities and all, wages and interest rates and among other things. So, these are could be there which say that we can have a relationship there and find out a model where we talk about how these different variables are affecting the economic indicator like GDP or growth in GDP for that matter. Moving on further in little more elaboration on this particular aspects, we have got first thing that we talked about is the monetary variables, that economy and the stock prices. The first thing that we talk about in this case is money supply. Money supply can be controlled by the particular federal bank in US or Reserve Bank of India in case India by having something like open market operations, change in the interest rate, change in the cash reserve ratio, change in the statutory liquidity ratio, all those things can be there where the money supply can be controlled. Now, what happens in the economy? The money supply is controlled, or let us say RBI tends to buy the securities from the government securities from the market, and what will happen because there is a demand, so there will the interest there is a more demand going to there, so price of the particular bond is going to be higher, and the price is going to be higher, and there is always an inverse relation between the price and the yield, or for that matter interest rate. So, the interest rate is going to decline. If the interest rate is going to decline, and that interest rate will reflect in the borrowing rate of the different corporates will also expect to decline, because ultimately this particular interest rate in the government securities is an indication for the other market like financial market or capital market, where the lending and borrowing can take place, and there the interest rate can also decline. If the interest rate declines, then obviously the expected return from the equity investment also can decline, because that is a little that can the bond interest rate can be a benchmark for the equity rate of return expect from the equity investment, which will be more than the bond interest rate, but can be only one of the leading to that as such. So, in that case what will happen, the value of the particular stock may go up for that matter, and then similarly because the interest rates decline, so that is why the one of the cost of the particular company also declines, the performance is going to be better. So, like that there is going to be a chain reaction with this one. So, similarly the negative reaction can be there if the government relaxes the economy, have more money supply, then interest rate may decline, may increase, and that can similarly can have different effects on the stock prices. Then this is one overall thing. Then there are certain agencies like Goldman Sachs for that matter, they have developed certain financial conditions index, where they instead of taking only money supply, they have taken certain 4 indicators like the real 3-month LIBOR, that short term interest rate, London Interbank Offer Rate. We have a contemporary thing in Indian case like MIBOR, this Mumbai Interbank Offer Rate. Then you have got real A rated corporate bond yield, then you have got real Goldman Sachs trade weighted dollar index, then you have something called equity market capitalization. If you look at this particular factor, that is FCI, GSFCI it is known as the real 3-time LIBOR, that is interest rate, as well as real A rated corporate bond yield is also an interest rate. It has got 90% weightage in this particular thing. So, one can see their overall index can be there, and one can find out there is a 1% growth or 1% movement in the GS FCI, and there could be 1% growth in GDP or some other relations can also be there. And GSFCI also has been developed from India, where there is same thing, you have interest rates, but you have got something called money supply is given weightage there, then the exchange rate is given some weight in stock market is 0.03, but also weightage is given. So, these are the things that we have in case of financial conditions index, which instead of taking a one particular factor, it takes into account different 3-4 factors, which are supposed to be talking about what is the financial condition in the market and how it is going to affect the, and we can see have a relationship between this financial condition index and the overall economic growth for that matter. Then as you discussed earlier, so money supply and stock prices can be related. So, as you discussed money supply, if there is a contraction in the money supply, that means there is a buying of the government securities by the Reserve Bank of India in Indian case, then the price of the particular bonds are going to be increasing, and price increases, the interest rate falls, and if the interest rate falls, then there could be 2 effect because of that, and that is the one of the cost of the company like borrowing cost can be reduced, that will improve the bottom line, the profit will be improving. Then second thing is the overall the rate of return expected by the investor also decrease, and these things can have a positive impact on the stock prices for that matter. So, all those variables are equally important, they are important to look at that. Yes, they have got certain effect, as it may matter as a lagging effect, a leading effect, or a whatever the chain reaction, they are going to affect the performance of the particular underlying stock for that matter. Then we move on to other factors like in the macroeconomic factors, that is we have got something like inflation, then we have got interest rates and how it is going to affect the security prices. If you look at the inflation and the interest rate, usually they move together. That means, if the inflation is going to be higher, is expected inflation to be higher. So, the inflation is positively related or interest rate related with interest rate. That means, the interest rate, in fact, when you talk about the nominal interest rate, it is nothing but the real interest rate plus inflation. So, the real interest rate is expected, let us say 5% and inflation is going to, let us say 6%. So, interest rate can be now 11%. Now, this is remaining constant. If this is going to be more or less because of the inflation, so it becomes 7%, that it becomes 12%. So, like that it will be there. So, there is going to be a spread between the real interest rate and nominal interest rate. So, this spread is going to be there. Usually one will find this spread to be almost constant or maybe little variation, but sometimes what happens, there will be a higher spread between these two particular things. That could be because the investors are not able to predict the inflation in proper manner. So, they are not good at predicting, that is why this particular gap may be actually increasing as such. Then we have got an interest rates and bond. So, what happens if the inflation leads to increase in the interest rate? Now, this will lead to fall in the bond prices. So, there is, because there is an inverse relations between interest rate and bond. The higher the interest rate, lower will be bond price, or lower the interest rate, higher is going to be the bond price, or you can say the yield and the bond price. There is a yield and the price are the inversely related. So, if this interest rate is going up because of inflation or for whatever reason for that matter, the interest is going to go up because of this whatever reason, then the bond price is going to be more, is going to be less for that matter. And it will also have another effect on the stock prices, the share prices. So, the overall interest is going to be increasing, the share price is also going to decline, which we are going to discuss in the subsequent time as in this session itself. Then we move on to the next slide. We next as we talked about interest in the stock prices. So, there may not be a very direct relationship, but not consistent, but there is going to be something, as you discuss. Interest rate can lead to the higher interest rate can lead to the reduction in the price of the stock for that matter, and this effect can also vary from time to time. They remain like unlike the bond, this particular relations may be so much consistent as such. Then another thing that you can talk about, looking at the yield curve. Yield is the yield from the government securities or the dated securities or for the bonds or the corporate bonds for that matter. So, if you look at the yield curve as such, it has relation between market yields and time to maturity, and we keep other things constant like credit risk or something like this is constant. How this yield is going to say, higher the time period more the yield, or higher the time period less yield, or there is no difference in the yield depending on the time to maturity. So, if the yield curve is upward sloping, and in that case if you look at the yield to maturity here, this is the time to maturity and this is the yield in percentage. So, if this is an upward slope, then we can say that there is a going to be increasing activity in the accelerating economic activity as such, and sometimes the yield curve, of course yield curve will not start with the origin as such, it will start something above, because it is unlikely that you have some yield which is 0%. So, you may have yield curve which is flat. So, that means there is no neither increase or nor decrease in the economic activity, but sometimes the yield curve can also decline, and this can be declining. In that case, we can say that the particular economy is in a declining phase as such, and that is or you can have an inverted curve. You can look at that there is going to be a fall in the economic activity, or is looking at there is a recession that is going to happen. If you look at the sample example here, we have got the yield curve. If you look at time to maturity on the x axis, then you have got on the y axis the yield to maturity there, and these are taken from the February 2010 data, and that point of time from the RBI which have taken, we can see that there is an increasing, and but over the period there is a little flat here. So that indicates that there is a growth, is not so flat, not so parallel to the x axis for that matter, there is an increasing trend here, and we can see that there is going to be a better or better economic activity in future. So we can, in Indian case, we can say yes, the growth is going to be there in the economy, that is indicated by the yield curve for that matter. It is not that very stiff slope as such, but there is a positive slope here, which is going is not a flat curve so much, it is also not an inverted curve for that matter. So which indicates that there is going to be a growth in the economy if you look at from today. Then we move on to other factors that affects the stock prices. They are called different predetermined variables. There are different models that is available, that is given by different authors, different researchers for that matter. But if you look at this one of the models, which is a general model for that matter, the stock prices can be a function of potential output of the economy, which will indicate by productivity, resources, the investment opportunities, projects taken by different companies for that matter. Then corporate tax rate for that matter, that is going to also affect the, obviously this is a simple thing, the corporate tax rate is going to decline, is declining, it is going to have a positive effect on the share price of a particular if the particular company for that matter, if the company is actually taxable in nature. Then the government spending also can have effect, and the government spend depends, the government spends more on infrastructure, that is going to lead to the infrastructure sector growth, and the companies which supplies to the goods to the infrastructure, for them there is going to be better performance for that matter. Then obviously as you discussed, there is a money supply, is going to be more or less contracting policy or a relaxing policy, that is going to affect the interest rate, and obviously the stock price is going to be affected. So these are three different policy variables subject to government decisions. Then we move on to the how we are going to capture this particular thing, that determining these stock prices from constant applying the particular classic model of dividend discount model. And if you look at the classic model, dividend discount model is as is given in the graph, we have got the P0 is equal to D1 divided by K minus G. So if you look at an example as we discussed earlier, price of a particular stock today is nothing but D1 divided by K minus G. So this is a classic dividend discount model. So if you apply this particular formula with the data, so the let us say D1 is equal to rupees 10, and D1 is nothing but the dividend in next year, expected dividend in the next year. So if the cost of capital or the rate of return expected by the investor is equity holder is let us say 12%, and the growth in dividend expected is going to be let us say 7%, 0.07, then the price of the stock is going to be 10 divided by 0.12 minus 0.07 is nothing but 10 divided by 0.05 is nothing but, if you take this currency rupee INR, then it becomes rupees 50. Now the point that you talk about here is that this particular price of a stock depends upon the expected dividend of the next year. Now also there is in the numerator, and also depends upon the denominator, that is we have got the cost of capital, the expected return of the investors, equity investors, and also the growth rate in this particular dividend. So in fact if you have it is a constant growth rate model, and here D1 is nothing but D is the present dividend into 1 plus growth rate. Now this numerator is a function of the past dividend and the growth in dividend is going to happen. Denominator is a function of the cost of capital or cost of equity or rate of return expected by the equity investor and the growth that is going to happen. Now there could be several factors which can affect this particular denominator or numerator. So, the numerator, as we discussed in the previous slides, if it is a cost of equity rate of return expected by the equity holders, that is going to be affected by the overall market condition. If for some reason, if the cost of the overall rate of return expected by a bond holder is going to be more, naturally equity holder is also going to expect little more return from the equity investment, because equity investment is supposed to be more riskier than the bond investment. So, because if let us not for anything else, nothing, not for the credit risk or for that matter, it is only for the macroeconomic factor the interest rate is going to go up, then the expected return from the bond is going to go up, and expected return from the equity also is going to go up. In that case, what will happen, this k is going to increase. At the moment the k increases, the denominator is going to increase, assuming that these two things do not change, and the price is going to fall. So, similarly, if there is going to be good activity in the economy because of favorable policy of the government, then there is going to be good growth, and there is a moment the growth is going to be higher in the profit, which is reflected in dividend growth. Then in the denominator there is an effect, is that is a negative sign to growth. So, what will happen, the denominator is going to decline. So, if this is held constant, then the price is going to be more. Similarly, another thing that is going to affect the D1 is also going to increase because of this growth. So, what will happen in that case, if the growth is going to be higher, the numerator is going to increase, denominator is going to fall, and price is going to be double affected, that is because of numerator increase as well as denominator decrease as such. So, this is the way one can find relationship between different variables in the model, and these variables in this particular model are also affected by different economic condition. So, look at, so we have inverse relation between interest rate and the stock prices, but may not be that linear, but it is going to have a effect. There could not a direct positive relationship, but there is going to be a relationship in that. Now, what happens, coming to the dividend for that matter, as we discussed in the last model, that is P0 is equal to D1 by K minus G. In fact, we can say it as K E. If you look at the cost of equity, there are different formula to estimate this one. The best thing that we can have is risk-free rate of return, risk-free rate in nominal term plus the risk premium. So, let us have a short form for this is NRFR, nominal risk-free rate of return plus the risk premium. So, the risk-free rate of return is nothing but there is a return where there is not going to be any decline, any fall, that is not going to vary. That means, the variation in this particular return is going to be almost 0 or negligible. Which type of instrument is going to be like that, where you have the no risk as such, as we discussed in some of the previous classes. The government security yield, that suppose somebody is investing in a 5-year bond or 1-year bond or whatever government security as such, the gilt-edged securities for that matter, they are supposed to be risk related, because we cannot expect the government is to default on the money borrowed for that matter. So, that is supposed to be risk-free rate of return. Now, if that is indicated by the yield on the dated securities. So, what can happen, if the investment is having a particular time horizon, looking at the time horizon, let us say 5-year, 8-year, 7-year, 10 years for that matter, the investor can also look at a comparable dated securities of that particular period, let us say 8 years for that matter, if his time horizon is, investment horizon is 8 years. So, from that they can find out, and that particular 8-year government bond yield depends upon, as we discussed the previous sessions, previous slides, that it is going to be affected by the macroeconomic factors, like money supply can itself affect that, or government policy can also affect that. So, that can be increasing or decreasing. Coming to the risk premium, the risk premium is the extra return that the investor expects over and above the risk-free rate of return, because equity is an risky investment, and this risk premium can depend upon different factors like macroeconomic factors. Industries, so that particular industry may not be that good, there some variation is possible, or this particular company's condition may not be that good or may be very good, depending on the RP can also increase or decrease. So, that is overall this cost of equity is going to be affected by different conditions in the economy and the company's condition also. Now, coming to the next thing, that is in this case G, as well as this is nothing but D0 into 1 plus G, So, we have got growth rate, and this particular growth is nothing but growth in dividend, which depends upon the growth in profit of the company, and the profit of the particular company depends upon the revenue, depends upon the expenses, because revenue minus expense is going to be profit, depends upon the tax. All those things are going to affect again further by something else like overall demand conditions in the market, supply conditions. If the supply conditions is not that good, the cost of production may be higher, so profit is going to be lower. Or demand condition is good, so demand is going to be good, so your realization for the revenue is going to be higher, so revenue is going to be higher, so that is going to affect the profit, going to positively affect it, so profit is going to be higher. So, all those things, then the company can go for a capital expenditure, more expenditures, it can company can claim more depreciation, then the profit can be lower for that matter. So, all those things that is going to affect the company's top line, bottom line, or the intermediate things like the cost structure for that matter, they are going to affect the bottom line of the company profit, and that profit is going to increase or decrease, and that can be because of different, as we discussed, in the different macroeconomic variables, and that is going to be there. So, in that case, this particular dividend is also a function of profit. Profit is a function of the cost and revenue structure of the company, and revenue is a function of the company's products as well as the industry condition as well as the macroeconomic conditions. All those things are ultimately going to affect the value of the share of a particular company if you go by this particular classic dividend discount model. In fact, this particular model can be further, as we discussed in the previous class, in the valuation of securities, we have something like valuation of equity is nothing but free cash flow for equity of the next, if it is a constant growth model, then KE minus G. So, this growth is in growth in this particular free cash flow to the equity. Now, instead of taking dividend as the model, somebody may question it, because investors do not invest in the stock because of dividend, rather you go for a more popular approach that you have the people have come with, that is free cash flow for equity. So, this free cash flow of equity is a function of profit after tax. Then what we would do, we add back the depreciation, because depreciation does not involve any cash outflow. So, that is getting added. Then we take out the net capex or net investment, then take out net working capital change, right, and then you have got other things which is a commitment for the company, and we can go for net borrowing. So, all those things are there, net borrowings. Now, if you look at the, as we discussed earlier, profit after tax is function of revenue and cost, then your depreciation is a function of what? It is a function of existing assets as well as expansion in the fixed assets. So, the depreciation can be more because there is a fixed assets itself has grown. Then coming to the net capex or the capex for that matter, is not net capex, it is capex, that is capital expenditure. Capital expenditure net of depreciation because net capex. So, capital expenditure is nothing but the investment in capital assets and fixed assets for that matter. So, that is going to be more if there is an there is a expected demand for the particular product is going to more in subsequent years. So, you have to build up on a capacity and produce more, and so that you can produce more in future. So, the capex is going to be more. Then we need money for regular activities like working capital, like in inventory we can have some money we require, then we will have some receivables, additional receivables, we may need to have some additional cash. So, that will be reflected in the working capital, and we will have some current liability support. So, in that case, net working capital is going to be nothing but current assets minus current liability. So, how much extra working capital is going to be there, that is nothing but change in working capital. So, that is also going to be taken out of this particular profit. Then we may have a borrowing from the market or from the lenders or through the help of debentures, bonds for that matter. So, this borrowings can also, net borrowings nothing but the new borrowings less the repayment that has taken place during a particular year, and this borrowing is going to also affect the cash flow, it may increase, and the borrowing will depend upon again what, first thing is that we require finances for the expansion possibly. Second thing is that even if you require finances, we may feel comfortable with taking a borrowing or may not feel comfortable going for borrowing as such. So, if the company goes for only equity for financing, then net borrowing is going to be negative, depending upon this borrowing there is a repayment of borrowing that is going to take place. So, all those things that we are talking about in this particular factors that is affecting the variables which affect the free cash flow equity are in turn affected by certain conditions related to company, economy, overall economy, of course, with the reflecting the international economy. For instance, if there is a export oriented unit and the export is going to be more or going to be less because of the economic condition elsewhere, then that is going to affect the revenue, that is going to affect the profit after tax, and all the things are going to affect as such. So, all those things have to be considered for the valuation of a particular stock or determining how much to pay for the particular stock, or to go for buying or selling or whatever that may be. So, these macroeconomic factors, economic factors are going to be very much important factors from the valuation of stock or the invest decision for that matter. Now, we move on to the next, that what do you do, how do you value the market, as we discussed in previously. Overall, we talked about the dividend discount model, we talked about the free cash flow model, then you talk about the fundamental analysis. You can affect the economic factors, that is stream of shareholders benefits, that is earnings or dividends, and then required return on earnings multiple. So, earnings or dividend, that could be the expectation like the earnings per share or dividend per share, then having that particular value, then we can talk about and what is the value of the particular share. Then the earnings stream, as you discussed in the previous few minutes back, estimated GDP, the corporate sales, the corporate earnings before tax, then corporate earnings after tax, which is nothing but after the tax is deducted from there. All those things are going to affect the particular stock's performance, the underlying performance, and accordingly what will happen, one stock, and then you have a couple of other stocks also that are going to be affected, and overall index is going to be, market index like Sensex or Nifty in Indian context, or S&P in US context, or Nasdaq for that matter. They are nothing but the combination of different stocks for the matter. The stocks are affected by this, and the overall index is going to more, better, or worse for that matter, increasing, decreasing trend, all these things will happen, which are eventually affected by different macroeconomic factors as such. Then we have got other models, like we have got one model here, the dividend model. We also have something called earnings multiplier. The celebrated earnings, the celebrated multiplier, we did discuss about this in valuation of securities applying relative valuation. We have got a celebrated model like price to earnings ratio. So, if EPS has been estimated, EPS is nothing but profit after tax divided by number of shares, then if the P ratio is also estimated, it is earnings per share is expected to be 8 and P ratio is expected, let us say there is a benchmark by someone, is P ratio is let us say 10, and then the value of share is going to be expected is going to be 80 rupees. So, this is the value of share, which is nothing but a product of earnings per share and the price earning ratio. That means, the investor is expecting that 10 times the EPS the valuation should be. Now, the point here is that this EPS can be the lagging EPS, that is the earnings per share which is already declared based on the results declared already, and another can be that you have got forward EPS. So, forward EPS is now more prominent, which is nothing but the expected EPS earnings per share in the next quarter or next year for that matter. So, now as you know, the expected EPS is a function of the expected revenue. The expected revenue of particular company is function of besides the company's factors, company's products, demand for the particular product in the economy for that matter. Now, it may not be easy for us to extrapolate from the past P ratio to the P ratio, because we can have different change that can happen, and we this observed empirically that the P ratios are higher when inflation interest is going to be lower for that matter. And so, what can happen here, one can do is that one can put the earnings estimate and the multiple together and look at the valuation of the particular share. So, the earnings have to be estimated and the multiplier also going to be estimated. The multiplier cannot remain constant across the time period, it is going to change because of the expected return of the expectation of the investors based on the economic condition or the industry condition for that matter. Then we move on to the next thing, that is how much we can actually forecast the changes in the market. It is not so easy to forecast the market continuously, in particular in the short term. And another problem that we have, that is on efficient market hypothesis, EMH. There are different form of efficient market, as it has been discussed, it is going to be discussed in some other sessions on efficient market hypothesis theory as such. And this says that we, in a very strong form, we will say that the price, whatever the sensitive, whatever the price relevant information that is available for the in the market, it is known to all the investors at once only. So, there is no question that somebody has got certain price sensitive information and another person does not have, everybody knows that. So, another thing is that the EMH also talks about that we cannot, the past is not an indicator of the future. So, the future depends upon then whatever the particular information available, which is instantly available for these for the investors. But it is also true that all the market in economy in the entire world are not having this very strong form of efficiency. There are certain weak form of efficiency. In that case, we can find that possibly the previous stock prices can affect the future or the present stock prices. But if you go for very strong form of efficiency, then we can say the future cannot predict based on past information. So, in that case, one can simply say that we need not go for an economic analysis, because in any case these past indicators, whatever has happened, they are not going to affect the stock market's performance. Stock market performance depends on something else, information readily available in that case. Possibly if somebody rejects this particular analysis, possibly somebody may look for something technical analysis as another mechanism to go for a stock investment decision, buy or sell decision for that matter. But the market timing also something like that, and certain times what happens, you have to, even if you believe in economic analysis, this has got certain influence in the stock market, timing is also going to be difficult. That means one has to be able to predict, yes, the economy is going to be up, and so the stock price particular thing is going to be higher. So, this may be the right time for me to buy the stock, so that we can book the profit in future when the actually prices go up. Similarly, if one can forecast that the economy is going to decline, in that case if I am holding a stock and that particular stock is affected by the economy as such, and economy is going to decline, the particular stock price is going to decline. So, keeping that in mind, I may sell this stock today and book the profit now itself, and I do not suffer the losses in future. But that is the problem that all the investors that they face. They may not be able to forecast the market so diligently, so accurately, so that they can take the decision and take the advantage of the condition in the market. So, what happens, the people actually lose more by missing a bull markets. Most of the time the people may lose or they do not have the opportunity to gain because they miss the bull market, whereas the bear market they may not be able to avoid, and so they are not able to gain out of the market in the good market, and they are rather going to lose because they are anyway trapped in the bear market. So, they are going to lose because they have to sell the shares at a lower price, or their investment value is going to be lower. Even if they do not sell the share, the value of the investment is going to be lower, because there is a market price, overall market, that rates up, the index or everything, stock prices have declined the market for that matter. Now, we move on to the how do we use this business cycle to make the market forecast. So, as we discussed again in the previous slides, the investors can recognize the bottoming of the market economy. That means, there is going to be a flat, and so if you can, one can predict. So, let us say we have a economic cycle like this, where you have got a peak, then there is a fall, there is a recessionary condition. So, obviously, we cannot expect that it is going to decline less, there is going to be decline after a peak, and this decline is going to be up. If there is a intelligent investor that is available in the market or analysts are available. So, if the investors can forecast, yes, now this is the last point in the market, that is the economy, and this particular thing is going to go up. So, this may be the right time you can recognize to buy certain, go for invest in the stock. If you have got cash liquid assets, it is better that you convert them into financial asset like stock further, because there is going to be a recovery in the market, a recovery in market, growth in market, economic indicator is, and we are going to, the stock price is also going to, because they are supposed to be something like lagging leading indicators is the stock price index and all those things. So, that is going to be more. So, that stock price is going to go up because the demand, and accordingly. So, that will be more, that will be happening only when all the people feel like that yes, there is going to be recovery and all people will go now go for buying the stock. So, when they are going to buy the stock, the price is going to be higher, and the moment the price is going to be higher, there is going to be increasing trend, that will be followed by the increasing trend in the economy. So, you can say here that yes, the as you discuss in the indicators, that is in cyclical indicator that you talked about the leading indicators, the stock price index or stock price for that matter is a leading indicator of the economy. This is the way one can explain that for that matter. Similarly, if after reaching the particular top line, top in the particular growth in the economy, and if somebody can predict yes, this is the time, this is the ultimate point the economy can reach, and now there is going to be a decline, is a flattening here itself, then it is a right. If somebody can predict, then if you are holding the stock, there is likely that it is their particular stock economy is going to decline. So, ultimately stock price is going to be lower in the future. So, it is better that we sell the shares now and book the profit, and then it falls, so that we do not have any, the investor does not have any problem when the actually there is a decline in the market, if because the ultimate maximum gain has already happened. But the point is that no single investor is the only intelligent investor available in the market. All the investors also have all the same, almost particularly the informed investor have the all the information, and they can also think in that way. And in that case, what will happen? There will be a demand, there will be a supply, there will be sale of the shares, and the moment the sale of the share takes place, the price of the share is going to decline, and the price of decline, there is a bull, there is a bear market. And because why is bear market now? Because they are expecting the economy is going to do worse in future, the recession is going to happen or decline in the market will happen. So, that will now be leading that yes, now there is this stock price is falling because in anticipation that tomorrow the corporate earnings is going to decline because economy itself is declining. So, depending upon that condition, one can go for switch into stocks out of cash. As the economy recovers, stock prices may level or may even decline, and based on the past, the market P usually rises before the end of the slump. This is an observation by different analysts or different researchers, that the market price earning ratio will rise just before the end of the slump. That means, at this point of time, this is the slump is ending, at this point of time the P ratio is going to be higher, and P ratio is going to be higher. Why? Because whatever EPS is there, then your price, this is going to be up when the price is going to be up. That means, expect the price of the share is going to up, some, that is why the P ratio is going to be higher. After certain point of time, then this may stable, remain stable also. Then we move on to the other thing that you have, how the government's policy can also affect the asset allocation changes, imply the returns on equity and fixed income securities are related. So, what happens? The asset allocation means somebody has got an amount of money where he or she can put this money into stock or into fixed income securities, having a balance of both the things as such. Now, what will happen? One can, fixed income securities will yield will be there, it will be related to the government securities. If it is fixed income security, the government is going to be same as government securities yield. If the fixed income security is going to be some corporate bond or something like that, it is going to be little more than the government securities yield as such, because corporate bonds are little riskier. So, the expectation is going to be little higher than the government bond, which is supposed to be risk free investment. Now, one can compare this government securities yield with the earnings yield, that is earnings by P, or that is nothing but EPS by market price per share. So, the earnings per share is 10, market price is 100. So, earnings yield is 0.10 or 10%. this earnings to P ratio, the earnings yield is more than the bond or treasury note or the government security yield, that means obviously it shows that there is a T bill yield is, let us say 6%, then obviously earnings yield is more than the TB yield. So, that means the equity investment is more attractive. Similarly, if the, that means equity is attractive, whereas if the earnings yield is less than the T bond yield, then equity investment is not attractive. That means not attractive, what means that the government securities are or the debt securities are actually attractive. Then coming to the next thing, as we ultimately what we conclude from the discussion, market forecasts are not easy and not are subject, but are subject lot of error. So, forecasting has to be done by the investors, by the analyst, by the economist, but the errors also can also be possible. So, one should be ready for the error that is going to happen. That means, you may forecast something, but ultimately something may happen, something else may happen. So, those errors are expected. One has to take that in stride and go for economic analysis. And then if not the exact forecast that how much is exactly growth is going to be, let us say 10% growth in GDP or 5% growth in GDP or 8% growth in GDP, at least can there be little growth in the economy or is it going to decline in the economy, or maybe between some range of economic growth like 5 to 7% or 7 to 8%, not exact one, at least the direction can be inferred from the whatever the analysis that we have discussed. So, at least a rising trend or declining trend or there is a flat trend is going to happen, all the things can be there from the economic analysis one can find out. Then these are the certain reference that we have referred for the books. And coming to the Indian context, we have a for the all these economic indicators we have got certain data, and Reserve Bank of India has a particular, if you want looks at this particular site, the part of the as a part of the Reserve Bank of India, it has got almost all macroeconomic variables that are available. So, an interested analyst or investor or an education or a faculty member for that, or a student for that matter, can visit this particular site and extract the data or the download the data for that matter for doing his or her own economic analysis. As we have seen certain graphs that have been taken from this particular data, and one can use this particular source extensively. This data is obviously available free on the RBI's website. And then this is your concluding session of economic analysis. Now, in the subsequent session, we will discuss about the industry analysis followed by the company analysis. Thank you.